How does the housing market work, and what do we need to watch for a potential recession in the housing market? Let's get into that right now. Hey guys, I'm Rob Tetrault. Thanks for tuning in. Let's get into this housing market and understand how it works. So there's houses across the country and across the planet that are being bought and sold on every single day basis. A house is a real asset, right? A piece of real property that exists, typically a parcel of land with a house on it, and people trade these much like they do stocks, except they trade them on a much more illiquid basis, right? So if you're buying or selling a house, you're listing it, it's taking several months, you're going to prepare the home, you're going to maybe hire a stager, hire a real estate agent, you're going to clean it up, you're going to do some renos, you're going to list it. It might sell and then it might close in another month or two. It's a very slow, deliberate process, and it's very illiquid, meaning that you can't just get your house price on a daily basis, right? You get a different price every single time you would list it based on the buyers that are there at that time, based on, the pressure at that time, the area, etc. So selling a house is effectively like selling a stock in that you're going to put it up for sale. There's going to be bidders. You're going to sell it to the highest bidder. But it's unlike a stock in that it's much slower. It's much more illiquid. And you're much more uncertain as to how much you're actually going to get. When you go to sell a stock, you know what you're going to get for that stock because a second before it traded in the open market. So you know that that's what that stock is worth that second. Your house, yeah, maybe your neighbor sold for $1 million. Am I going to get $1 million? Oh, I don't know. My house is bigger, but there's no backyard, but we got the garage. The real estate agent tells you should get 1.1, but maybe you only get 900. So it's much tougher to know the real value on a day-to-day basis. Now let's get into what happens in a housing crash and what happens in a recession. So first off, the law of supply and demand, you know it. I don't need to explain it to you, but if I do, basically, the more demand that exists for a specific good, the higher the price will be. The less supply that exists for that same good, the higher the price will be. So if you have high demand, low supply, so a lot of people want to buy houses and not many houses are for sale, price will go up. Conversely, if you have a lot of houses and not many buyers, prices will go down. So that's the general crux of the housing market. Now, what else impacts it? Let's get into that. So there are a few things, specifically demand. So let's get into the demand factors that exist for homes. So what would cause more buyers, more demand for houses? Now, there's a few things. The first factor is the general health of the economy. If people are employed, if they're earning a lot, and there's wage increase and there's general health in the economy, you're more likely to get buyers of homes. Second of all, population growth. Now, population growth in Canada, anyways, has been largely stagnant aside from immigration. So if we can get 1% growth with immigration, that would be very good. 1.5%, 2% would be unbelievable. Generally, immigration drives economic growth and an increase in population, which fuels the demand for houses. If we get 1% population growth every single year, generally, all things being equal, we will need 1% more houses. So for every 100 houses that we have, someone's got to build one house. But it also impacts the demand. For every 100 families that immigrate, we need to have 100 houses, right? Now, some of those can be rentals, but some of those definitely need to be homes that are purchasable, and that will increase the demand. So we have the economy, we have the population growth, and the third important factor here is interest rates. Interest rates impact the cost, the after-tax and net cost on you, the buyer, when you're buying a home. Interest rates of 10% make it very, very difficult for you to fund the debt obligation that you will have when you buy a house. Interest rate of 1 or 2% or 3% make it easier for you to fund that debt obligation. So there's a whole bunch of stress tests that banks use to see if you can actually fund the debt in your home. Largely, interest rates are low, more demand. Interest rates are higher, less demand for homes. When it comes to the supply side of homes, it's a lot more flux and there's less opportunity to pinpoint exactly why there'd be less supply in a certain area over others. Sometimes it's government changes. Sometimes a certain government might be more pro-development or less. Sometimes it's economic. So if there's a recession, You might have people moving out of their homes because they can't afford it, or they're trying to sell their homes because they can't afford it and they want to rent. So a recession will typically be an increase of supply for homes. And you could also have price factors in the cost of goods. So if lumber goes up, if shingling goes up, if a whole bunch of cost to produce that home increase, you might have less builders wanting to build a house, therefore less supply. Conversely, if you can get land on the cheap, if governments are pro-development, developers are getting incentives to build, you might see an influx or a ton of supply. So think of the demand side, right? We talked about general health of the economy. We talked about population growth. We talked about interest rates. Think of the supply side, which could be, government's ability to encourage development. It could be health of the economy. It could be cost of the materials and goods. Think of those factors and what happens. So think if you have a ton of demand, less supply, or a ton of supply, less demand. Another factor that you definitely need to consider is speculation. Are there international buyers that are coming in and speculating on the asset class as a whole? Speculation is very dangerous for the price of homes because it tends to drive up the price. There's an increase in demand and there could be a reduction in supply. Speculating is buying an asset class, not to live in it, not to own it, but just to speculate that you could then flip it at a future date for a higher price. It's the greater fool theory. You think that you are not the greater fool. You think that there's a greater fool out there that's willing to pay more for the asset that you just bought today at a fair and reasonable market value. You think that you could find a greater fool, and therefore you buy this asset. There's a whole bunch of reasons for that. Some is there's a lot of international explanation as to why foreign buyers would want to come in and bring some funds into Canada. Some is that the security of our country, security of our banking system. But some is just international buyers want to speculate in Canada because they like Canada as a foreign investment. So if you get a lot of speculation, if you get a lot of developers that are buying, if you get a healthy economy that is pro house flipping, you could get a lot of speculators, and that could fuel an increase in price. And when you get that increase in price, you might be setting yourself up for a future drop in price, a future housing correction, or a future recession. All right, Rob, so break it down for me. How does this work? So bottom line, this at the end of the day, it's a supply and demand game. Do you think that interest rates are going to be significantly high enough for a significantly long time, so much so that we're going to lose potential buyers? Do you think that the recession will be so bad that they can't afford to make payments on their homes? They can't make their mortgage payments, so the bank will kick them out? It's possible that we see a mini correction into the price of real estate. It wouldn't surprise me. We've had such a run up on housing prices that some would call it kind of a healthy correction or a healthy comeback down to a reasonable number. And that's not a terrible thing by any stretch. It's certainly an acceptable thing. Now, it sucks if you bought your home 6 months ago or a year ago and now you're down 10%. That could happen. But largely, my belief, especially in my home province of Manitoba, there will not be a significant housing correction in my home province. A lot of the markets are fairly isolated. Average home price is $400,000. There will not be a housing correction in Winnipeg, Manitoba, Canada. There might be a small price correction, but we're not going to see an all-out housing recession, and we're not going to see an all-out housing crash. Now, spicier markets like Toronto, Vancouver, and Montreal, they could potentially see a larger move, given that the average home price is closer to $1 million. That's possible, but the larger markets have had those strong gains for many years, right? So the bottom line here is if you're living in an isolated economy with stable markets, some of the mid-tier cities, the mid-market cities, you're likely going to be safe. You might see a small valuation, a small correction, but that's fine. The larger markets, you do have to be careful. At the end of the day, what does this mean for you? All right, so if you're a home buyer, here's my advice for you. Don't let an unknown variable that you don't know control the timing of your house purchase. Someone might tell you, wait a year, wait 2 years. It's going to be a lot cheaper. I call BS on that. My advice to you is when the timing is right for you and your family or you to buy a home, okay? Because you don't know what's going to happen in 3 and 6 and 9 months. It's like buying a stock. If you need to own that stock today for your portfolio, buy it today. Whether it's up or down in 3 months or 6 months, it's kind of irrelevant. Long term, you will be up and you don't know what's going to happen in 6 months. So my best advice to you is if you're buying a home for the right reasons, in other words, you're not speculating, you're going to live in that home and it's not going to be an investment that you're going to try to flip and sell to someone else, I would suggest that you buy a home whenever you're ready and not try to time the housing market. It's almost impossible to do. There you go, guys. Take a sec to like, subscribe, give us a follow. I'd love to hear your thoughts. If you got some comments, put them below. Thank you for taking the time. I'm Rob Tetrault, Portfolio Manager at CG Wealth. I will see you in the next video.